Hi, in this video I'm going to take you through chapter 4 of our textbook, and we're going to look at different responsibility centers and how we can organize various departments. Let's get started. So let's have a review. Just to remind you, a management control system is a combination of control practices designed and implemented by top management to increase the probability that low-level managers' employees will behave in ways consistent with the organization's missions, goals, and strategies. And these are comprised of input, throughput, and output controls. So remember that the main goal of management control systems is to align employee behavior and make sure that everyone's acting in a way that's increasing the organization's chances of success. When we think about throughput controls, these are control practices that direct low-level manager and employee behaviors through formal delegation of decision-making responsibility and by specifying how behaviors are to be performed or not performed. A responsibility center is an organization unit that is headed by a manager who is responsible for its activities. So this is a center that has a manager, and that manager has a goal, and their goal is to direct the activities of that responsibility center. An organization is a collection of responsibility centers, and each of which is represented by a box on an organizational chart. The organizational structures can be read as a collection of responsibility centers. So here are an examples of different responsibility centers. We have investment centers, which would be our head office and Division A and Division B. We have profit centers, which have various profit lines that are sold, and this would be Business Unit 1 and Business Unit 2. And then we have revenue centers that are just responsible for sales, and here we have our sales unit, production units, and research and development units. And here we have an engineered expense center, which is the production unit. Remember, our production unit does not create revenue, they generate costs. And then we have research and development, which are discretionary expenditures, but we need R&D to ensure that the business will be successful in the future. Now let's look at our next slide. Overview of responsibility centers. A responsibility center exists to accomplish one or more objectives, and there's different types of responsibility centers. We have cost centers, we have revenue centers, we have profit centers, and investment centers. Every organization can be thought of as a sum of its responsibility centers. Thus, if each responsibility center meets its objectives, the mission, goals, and strategies of the organization will be achieved. And when we think about designing responsibility centers, the key is to analyze the organization's core operations and assign each core operation to a responsibility center. And it's really important to ensure that each responsibility center has control over its processes and the objectives and the criteria that you are going to use to measure its effectiveness. Criteria for assigning responsibility centers. When we decide how to assign responsibilities, the core operations of the unit and the measurement possibilities of inputs and outputs should be used as starting points. Decisions how to allocate responsibilities are intimately related to a company's organizational structure. When assigning responsibility centers, managers need to be cognizant of the controllability principle. And what our controllability principle dictates is that managers should be assigned responsibility only for the revenues, expenses, or assets employed that are under their control. So you can't assign responsibility centers without giving those managers decision-making authority. So they should be able to control pricing if they're a revenue center, and they should be able to control costs and the various inputs that are purchased to make the product if they are a cost center. Because it is demotivating to assign managers responsibility for factors that are outside of their control. So you really have to make sure that they are assigned to responsibility centers that they have decision-making authority over. When we think about a responsibility center, we can think of it as a place where work is done. So there might be some inputs coming, resources that will be used by the center, and these might be measured by the cost. And that responsibility center performs work, and after their work is completed, outputs are created, and these outputs can be goods or services. They could be finished products, or they could be an input to another responsibility centers. So responsibility centers receive inputs in the form of material, labor, and services. The responsibility center performs its particular function using working capital, equipment, and other assets. And its objectives are to transform inputs into outputs, and these are either tangible or intangible. And the outputs from a responsibility center may be transferred to another responsibility center where they are processed further as inputs, or they might go into the outside marketplace, as I mentioned, as finished products for the organization as a whole. And responsibility center managers are responsible for ensuring the optimal relationship between inputs and outputs. So you're either maximizing revenues, or you're minimizing costs, or you're maximizing profits by maximizing revenues and costs. And which criteria you measure the responsibility center on is based on what type of responsibility center are you looking at. There is always, in management accounting, we always talk about the differences between efficiency and effectiveness. Responsibility centers' performance can be measured by either how effective and efficient it is. Efficiency is usually thought about as a ratio of outputs to inputs, or the amount of output per unit of input. So here you're looking at whether there's scrap products, how many products can you make by introducing a certain level of inputs. In many responsibility centers, efficiency is measured by comparing actual expenses with some standard of what those expenses should have been at a measured output. So this is where we get into standardized costs that you should have looked at in 3370. Whereas effectiveness is the relationship between the responsibility center's outputs and its objectives. The more this output contributes to the objectives, the more effective the unit is. Effectiveness is expressed in subjective, non-analytical terms. So this is usually qualitative. You're making inferences and you are using your subjectivity to evaluate effectiveness. And a responsibility center is efficient if it does things right, and it's effective if it does the right thing. So these are quite different criteria, and both are important. And it is as important to be effective as it is to be efficient, if not more so. because sometimes you might be efficient, but you might be doing the wrong things. Now we're going to talk about different types of responsibility centers, and I alluded to some of them. There are 4 types of responsibility centers, and they are usually classified according to the nature of the monetary inputs or outputs that are measured for control purposes. We have revenue centers, and output is measured in non-monetary terms, and the manager is responsible for revenue only. So think about the sales department as being a revenue center. They're not really responsible of the cost of the products, but they are responsible for the price and how much their revenue they're able to generate. Then we have expense centers, and inputs are measured in monetary terms in these centers, and the manager is responsible for expenses only. So here, think of a production unit that is trying to minimize the cost per unit sold. We also have profit centers that look at a combination of outputs and inputs, and both revenues and expenses are important for these centers, and managers are responsible for profit. So here managers would have control over both pricing and the cost of the products. Lastly, we have investment centers, and here the relationship between profits and assets is measured, and the manager is responsible for both the assets employed and profit. So here we're also looking at investment opportunities and long-term assets and how those assets are utilized and asset utilization. These centers are responsible for their capital budgeting, and they're making long-term investments. So investment centers are centers where managers have the most control and hence the most responsibility. Let's look further into each. Here we have revenue centers. Inputs are not related to outputs, and revenue is only measured. In a revenue center, revenue is measured in monetary terms, but no formal attempt is made to relate to input to output. So expenses are not controlled by revenue centers. Revenue centers, as I mentioned in the last slides, are typically marketing and sales units in which managers neither control the cost of the product or service they market, nor the investments made in the unit. Focusing only on revenue may have undesirable consequences for the company as a whole by downplaying the link between sales units and other organizational units. And you don't want to build competition between departments, especially unhealthy competition. And if 2 or more responsibility centers participate in a successful sales effort, both should be given appropriate credit. So for example, if we have responsibility centers based on geography and a big sale is made to a client that operates in 2 different markets, both of those responsibility centers for those markets should be awarded. Now let's talk about Now let's look at expense centers. Expense centers are responsibility centers whose inputs are measured in monetary terms, but whose outputs are not. They are often called cost centers because they are responsible for producing our product and minimizing costs. There are 2 different types of expense centers based on various expense categories. We have engineered expenses, and these are expenses for which right or proper amounts can be estimated with reasonable reliability, such as production units. You can figure out the raw materials used or the labor used. And then we have discretionary expenses, and these are expenses for which no such engineered estimates are feasible. And these expenses incurred depends on management judgment on what is appropriate. So these are expenses that are much more difficult to quantify. Now let's look at engineered expenses. There are a few common characteristics that engineered expense centers possess. One is that their output can be measured in monetary terms. The second characteristic is that their output can be measured in physical terms, for example, the number of units produced. And the optimal monetary amount of input required to produce one unit of output can also be determined. When you think of engineered expense centers, you can think of operations such as manufacturing, warehousing, distribution, or trucking, where there are physical products being made or physical machinery being used, and it's easy to track it. Usually these types of industries perform repetitive tasks, so it is easy to develop or create a standard cost that then you can evaluate the actual costs again. Output can be multiplied by the standard cost of each unit to measure what the finished product should cost. And then you can always perform variance analysis to determine why there's differences between actual costs and standard costs. And then the difference between our theoretical costs and the actual cost is measured and evaluated. And this is how we can measure the performance of this expense center to determine if it's doing well and it's being efficient or if it's doing poorly. Engineered expense centers refer to responsibility centers in which engineering predominates, but it does not imply that valid engineer expense estimates can be made for every expense item, just a majority of the items. Now let's look at discretionary expense centers. Discretionary expense centers include administrative and support units such as R&D, operations, and most marketing activities. The output of the centers can't be measured in monetary terms. Top management must decide the optimal expense amount and their opinion of what is appropriate levels of these types of expenses, and these are subject to change because they're subjective. In a discretionary expense center, the difference between budget and actual expense does not incorporate into the value of the output because these expenses often aren't related to production output. The main purpose of these discretionary expense budgets is to control the expenses by allowing the manager to participate in planning, sharing and discussion of what tasks should be undertaken and what level of effort is appropriate. In a discretionary expense center, financial control is primarily decided by management before the expenses are incurred. They're usually planned expenses, and it is unwise to reward managers who spend less than the budget amount because sometimes this may have negative consequences. For example, when it comes to R&D, you want to make sure the budget is spent so that new products and new ideas are constantly being innovated and worked on. If you decrease R&D spending, long-term profitability of the organization may be sacrificed. And control of discretionary expense centers is usually achieved with non-financial measures versus financial measures. Now let's look at the difference between profit and investment centers. Profit centers have responsibility over financial performance and they can be measured in terms of profit. So these centers have control over both the revenues and expenses, both variable and fixed costs. And profit is a very important measure of effectiveness and efficiency because this is ultimately what we report in our statement of profit and loss. Then we have investment centers, which have even more control over various resources than profit centers. because they will compare profits to assets employed. So there's an asset efficiency, and because you can compare profit to assets employed, that means that these investment centers have control over the assets that they purchase and utilize. And it is important to consider assets employed to generate profit to ensure a satisfactory return on assets. Investment managers, center managers have two financial objectives. One of them is that they should generate adequate profits from the assets at their disposal. And second is that they should invest in additional resources only when the investment produces an adequate return. So if they are able to generate more profit with the assets that they purchase, then that would be a valid investment. But if profits don't go up as much as the investment in assets, that would not be a good investment. An investment center is a special type of profit center. In order to create a profit or investment center, two conditions must always exist. The first one is that the manager should have access to relevant information needed to make decisions, and there should be some way to measure the effectiveness of the trade-offs between various investments that are being made. Now let's talk about some advantages of profit and investment center. First one is that the quality of decisions may improve because they are being made by managers close to the decision point that understand the business and are dealing with the day-to-day realities of those operations. The second is that because profit and investment centers are similar to independent companies, they provide excellent training ground for general management. So you are training and developing new talent who eventually might become the CEO or some other executive in your organization. And the third advantage is that cost conscientiousness is enhanced because managers who are responsible for profits will constantly seek to increase them. So they are going to look at the whole picture, not just revenue, but they're also going to look at costs and try to find efficiencies. Now let's look at some of the disadvantages of profit and investment centers. The first one is that decentralization might make top managers rely more on formal reports than personal knowledge because they're no longer as close to the decision making and they've lost the control, so they're relying on third parties rather than being intimate with the business. The second disadvantage might be there might be friction between divisions and there may be arguments on what should be the appropriate transfer price. How will we assign common costs? Who's going to get credit for revenues that are generated by two or more units? So various divisions might see each other as competitors versus a holistic company. There might be additional costs because there's additional layers of management, personnel, record keeping, and this may create redundancies at each profit and investment center. Competent general managers may not exist in the functional organization because they haven't developed all the competencies required. And there might be too much emphasis on short-term profitability at the expense of long-term profitability, especially if you are measuring management's performance based on profits. Now let's look at turning functional units into profit centers. Managers must decide on whether to turn units into profit centers based on the amount of influence or control that units managers exercise over activities that affect the bottom line. You have to look at marketing, production, services, and supports that can be turned into profit centers and what kind of transfer price policies should be utilized for these centers. And for service units and other profit centers, you should have the option of procuring these services from an outside vendor to ensure that the service unit is staying competitive and providing a value-added service. In the next chapter, where we talk about transfer prices, it is always important to make sure that any unit that is providing a transfer price to a unit within the organization is competitive. And one way to do this is to look at how much it will cost to procure the service outside. Now let's look at some constraints on profit and investment center authority. When there are constraints placed on profit centers management authority by corporate office, their evaluation should be reflective of these constraints. So profit centers should not be penalized for decisions made by corporate office that are essentially outside of their control. Responsibility centers always reflect the trade-off between unit autonomy and corporate constraints. So to be fully autonomous, the responsibility center would act as its own organization, but that somehow isn't always the best decision. So sometimes there are corporate constraints placed on these responsibility centers. But as I mentioned, those responsibility centers should not be penalized on or measured based on corporate constraints. It is useful for profit centers to have control over these types of activities to be really classified as profit centers. The first one is the product decision. The profit center should be able to decide what goods or services they're making and selling. They should also have authority over the marketing decisions. So this relates to how, where, and for how much these goods or services should be sold for. They also should be responsible for the procurement or sourcing decision, how to obtain these goods or services, and should they be manufactured in-house or should they be procured from an external vendor. However, the constraints imposed by top managers are always there, and we can usually classify them into two types. One is those resulting from strategic considerations. If an organization has intellectual property, they might want to produce certain things in-house rather than give their intellectual capital to an external vendor, even if that external vendor can produce it for in a less costly manner or for a lower cost. And then we have those resulting because of uniformity is required. If organizations have already made huge investments, then it doesn't make sense to hire external vendors. So one of the major constraints that is placed on profit centers is corporate control over it. That's it for Chapter 4. Thank you so much. Please let me know if you have any questions. Have a great day. Thank you. Bye.